Stocks are selling off as we head towards the close today. It's a tough day and a very tough one for the Russell 2000. That's leading the decline, and all of that coming after that hotter than expected inflation report. Down 2.5% today. That's the Russell 2000. You see it there. Chris Hyzy of Merrill and Bank of America Private Bank with me now. Joe Terranova, of course, of Virtus is here because we're having a conversation about small caps and the Russell a little bit earlier. Joe's a CNBC contributor, as you know. Chris, it's good to see you again. I appreciate you being here. So what should I make of the Russell when I've heard from more than one person in the last 34 and a half minutes say no way for the Russell right now? You say otherwise?
Well, I say depends on what your time frame is. I mean, if you're starting now and you're way underweight small caps and you're thinking out at least 12, 18 months, yeah, I think it's a great opportunity. And I think it's going to take some time. And just listening to some of the programs before, it's pretty obvious that they have some pressure points to them. The small and mid-sized bank exposure, we know that story there. The fact that the Fed hasn't cut rates yet, we know all of that. But, stocks are a discounting mechanism. And what we find in small caps is if you take a look at the individual constituents, that's a much better way to think about investing in them. If you're just going to own the index, it's a little bit more difficult.
But when you say the implication you make when you say that stocks are a discounting mechanism is that you get the anticipation of an event happening, therefore you're supposed to buy something or, for that matter, sell something before the actual event occurs. I raised that issue earlier to where they still say, no, it's too early. What if rates remain where they are for a period of time? Who cares if they're going to cut rates? The fact of the matter is this sector is just too challenged right now in a higher rate environment.
Certainly overall, just, at the top of the index, a higher rate environment, balance sheets aren't as good, not a lot of companies growing, but that's at the full aggregate level. If you think about where the Fed has told us they're going to go, even if they delayed a month or 2 months or whatever, the rate cutting cycle tends to benefit the lower quality areas. If you find lower quality, higher beta with actual earnings and good value, that's where we're looking at in small caps. Just saying small relative to large, I don't think tells the full story.
That's fair, and I think most people would agree with you. But, Joe, the premise, again, stocks are a discounting mechanism. Start to look forward, go where the puck is eventually going. Buy these now, selectively, but nonetheless, buy them now, don't wait.
I'm still not at the point where I have enough confidence to buy companies that are reliant on debt and companies that I can define as not profitable. 40% of the Russell 2000 index is not profitable. And I understand that Chris is saying don't buy the index. I agree with that. I think looking at the index itself is so detrimental to investors because the composition of it, Scott, is so remarkably different. Just look at the collective weighting of technology and communication services. For the Russell 2000, you're talking about 16% versus 38% for the S&P. The exposure in real estate is half in the S&P 500 what it is in the Russell 2000. So here's where quality absolutely needs to be applied. And in fact, the concentration concept of the Mag 7, I'd apply that to the Russell as well. Own a few small stocks in the Russell where you can find quality. In the last 5 years, the quality factor is up 67%, the growth factor is up 40%, the momentum factor is up 45%. Find a few companies. I'll give you two names. EMCOR, EME, that's exposure to infrastructure spending, and Simpson Manufacturing, ticker symbol SSD. Russell 2000 companies, industrial-oriented, quality companies.
Chris, what are we supposed to do with large cap tech? Because this plays into the conversation of whether we're in the midst of or the beginning stages of some kind of meaningful rotation where we need to start looking outside of those, large cap, quality, and momentum names which have done so well.
Yeah, I think, first of all, I think Joe just nailed the story on how to think about small caps in general, but just taking a look at technology in the large cap side, you hit all three things: momentum, quality, and cash rich. So you put those three things together, and the fact that the technology sector actually is the reason why earnings growth is in the S&P 500, and it was the exact opposite in 2022. What we're noticing right now is the beat in the technology names this last earnings quarter was right in line with the S&P. So what does that tell you for next quarter? Not sure yet. But if it happens again, and there's other areas that have a little bit higher beats to them, that's where the rotation that just started getting going becomes a little wider. And it's going to take time. It's not just going from one side of the boat to the next. So what I would say is, as you see Mag 7 go to Fabulous 4, that means the other parts of the market are receiving some of that money. And you're just starting to see it pick up in industrials, financials, selectively in healthcare, some big box areas in retailing. And I think that's very healthy. It doesn't mean be short or under benchmark, in my opinion, technology. It just simply means there's wider participation.